Okay, good morning. Today we are going to be starting in Chapter 9, and we will get through a significant portion of Chapter 9 today. So, Haley's with us this morning. Brian will be with us in the afternoon class. Wi-Fi's lagging this morning for whatever reason. There we go. Okay, what's due this week? Nice reminder here. Saturday we have Attendance Quiz 18, which covers class today and Monday, and Chapter 8 homework. Chapter 8 homework, reminder, it's a very, very short one. If I were you, I would be starting Chapter 9 homework. Chapter 9 homework is not due this weekend, but we're going to cover a significant amount of it today. So Chapter 8 you should be able to do in a relatively short period of time, just 2 exercises. 8 very, very short. And Haley and I were just talking about tutoring this week. If you are going to tutoring this week, she worked on 8 yesterday, very, very quick chapter, and then her emphasis is going to be Chapter 9, working on 9 this week. Okay, Sunday there's Video Quiz 19. It's actually over Chapter 9, which we're doing today. So they're a little, we're going to cover in class, and then you'll watch it then, and we'll have a little more next week. Next week, remember Monday, November 11th, the university is closed. There are no classes in observation of Veterans Day. And then Wednesday, if you sign up for tutoring, you'll get an email about where it's located. You can't just show up to tutoring. You will get an email from Haley or from myself about where it's located, and the location does shift depending on what day it is and the availability of rooms. Okay, so Wednesday next week, there is no live class. We will not be live online. We will not be live in person. Haley is going to have an open tutoring session at this class time at 7:45 next Wednesday. So if you're feeling like you want to come to class or you have this in your schedule, she will be here. She will not be running Collaborate though. There will be no online component. If you want to come, she'll be in this room at 7:45 next week to go over stuff, but we will not have the Collaborate, the live section, live part. Class will be recorded for next week. What Haley's doing at 7:45 is not class next week. It's just simply tutoring. We have the time slot available. We have the room available, so we just said we'd do it. I will be sending an announcement with links to the class for next week, for the recorded class segments next week. I'm not doing those until after today when I know how far we get. So it's just going to be what I would be doing live next week, except not live. Next week I am attending training Monday through Thursday in Virginia. So that's why we don't have class. I will be available via email next week, so there's no things like that. If you can still contact me. Yes. She will be going over stuff that I talked about. So she will be, so I assume the class that I'm recording for Wednesday that will be available starting this weekend sometime, we're going to do a little bit of 9 to finish up 9, whatever we don't finish on 9, and then we'll go into Chapter 10. And then she will be supporting that. So yes, on Wednesday during our normal class time. And she'll remind you about the lectures being online. So if you come here by accident, she'll be happy to help you. Okay? So, but yeah, so we were just talking, we thought we have the class time available, so it's a good opportunity. There will still be an attendance quiz next week. So that will be over those recorded segments that I email. So again, if you have any questions, send me an email, but I will be communicating that over the weekend. Is probably I'll get the stuff recorded Saturday, so I'll be communicating then that session. Okay, tutoring this week. As of last night, there were still a couple openings for one today. There was one near later session today, and then there were 2 openings for tomorrow. So check your email or announcements for the sign-up link if you want to go to tutoring with Haley. And we're going to get started then. Any other questions? So this is our last live in-person class for a week. Next week, no class on Monday because of Veterans Day, and then Wednesday, instead of Wednesday, we have a recorded class. But Haley will be in room 200 at 7:45 for tutoring if you'd like to do that. Okay, so Chapter 9. Now Chapter 9, there are 5 learning objectives in the chapter. We're covering 4 of them. So we're covering learning objectives 1, 2, 4, and 5. Learning objective 3 is not in study plan. It's not in your homework, so you do not need that. This chapter is not too bad. There's certainly more homework in Chapter 9 than there was with 8. But Chapter 9 is about liabilities, and liabilities are things we owe people. And liabilities, there's a simple liability, I think, hi Jennifer. There's a simple liability where we say, okay, we go to Staples and we buy a box of paper and we sign and say we'll pay you in 30 days. That's a pretty standard liability. And that's pretty easy to understand because we get the merchandise, we say I owe you, and we pay later. And that's an accounts payable. That's a current liability. We can also have long-term liabilities. Long-term liabilities, we sign a mortgage with the bank and we're going to pay our mortgage over the next 30 days. That's a long-term liability. So those are both pretty straightforward. We know that we owe the money. We know why we owe it. It's not contingent on anything in the future. But then we have something called contingent liabilities, and that's what makes this subject a little more challenging. What about a potential liability that depends on a future outcome of past events? So, okay, so an example of this, what if you're being sued? Okay, is that a liability or not for this people, maybe a company, a consumer suing you for an injury? Do you have to recognize that as a liability? So those are called contingent liabilities. And whether we record them or not depends on the situation. We would accrue them, meaning we would say let's say for example, a customer is suing us for $100,000 because they got injured by spilled coffee, because that's a classic one. So they're suing us for $100,000 for spilled coffee. Now, our attorneys tell us that it's probable that we'll lose the lawsuit and it's probable we'll have to pay $50,000. At that point we would say, yeah, we'll accrue this liability, meaning we'll recognize it. We're going to set up a payable account and we're going to set up an expense account for the amount of the loss. So that's when we would accrue it. And accrue simply means we recognize it. It's going to be on our books. It's going to be on our balance sheet as a liability. It's going to be on the income statement as an expense or loss. Okay, so that's the circumstance. The loss is probable and we can estimate the amount. Now, if the attorneys, on the other hand, say, oh, it's reasonably possible we'll lose this lawsuit, there's a reasonable chance we could lose, or we can't estimate it, we'll probably lose, but we don't know how much, then what we do is we do something called disclose. And disclose says we're not going to put it on the balance sheet. We're not going to have a liability for this because we don't know the amount and it's not probable. It's not for sure. So disclose means in the notes to the financial statement, which comes after the financial statements, we are going to say, in those notes we'll say contingent liabilities, and we'll describe the lawsuit and say our legal counsel has indicated, that we have this lawsuit. So we'll disclose it. We're not going to give away trade secrets. We're not going to acknowledge guilt or anything like that, but we will disclose it. And then if we have a lawsuit that's determined that our attorneys feel there isn't a case there, that it's very unlikely that we would lose it, we don't even disclose it. So basically, if we have things like lawsuits, we accrue if we can estimate the amount of the loss and it's probable. We disclose it if it's reasonably possible we could lose it, because our investors need to know there's lawsuits pending against us if there's any kind of reasonable chance that we would lose it. Okay, so those are contingent liabilities. Another example of a contingent liability is warranty work. Okay, so we sell, let's say we're Ford Motor and we sell cars all the time. Well, there's a good chance that there's going to be a recall on something along the way. So when do we acknowledge that we will have recall expenses? So again, we're looking at, we accrue them when we realize there's going to be a recall and we can estimate the amount. We disclose it if we're not sure. So there's all different levels of contingent liabilities. So we're just going into the basics. So I would know the circumstances for accruing or recognizing. Accrue, we can also substitute the word recognize in this case. So to accrue or recognize a contingent liability, the loss would have to be probable and the amount estimatable. So we can estimate how much it is. To disclose it, the loss only needs to be reasonably possible. And then if it doesn't fit those criteria, we don't disclose it at all. Okay? Okay, now this chapter has a bunch of different things. Haley, can you move the mouse? Yep. Okay. We also, in this chapter, talk about bonds. And these are bonds of our own because we're talking about liabilities. So a bond is a way for us to borrow money. So a traditional model, a business goes to the bank and says, I need to borrow $1 million. And then the bank writes a loan. But going to the bank for a loan is expensive. Banks charge a lot of money. And there's a time and place for bank financing. But a more efficient mechanism for a company that's got a credit rating with Standards & Poor's and is well known is to go to the market and say, well, I'm going to go to the market. I'm going to issue a bond, which is simply saying, you give me, investors, give me money, and I will pay you back in 30 years in the future or 10 years or however long our bonds are, and I'll pay you this interest rate. And this interest rate is more than you can make at a bank. So a company will go to the market and say, I'm going to issue a 4% bond, which is cheaper than they can borrow from the bank, and it gives a higher rate of return for the bond investors. So companies, if they're a national or international company with a credit rating, well-known, trusted, can go to the market to borrow money. And when they do that, it's called a bond, and they actually will issue a bond, which is a legal instrument, and they will have to pay the principal back at the end of the bond, and then they will have to pay interest on the bond, typically twice a year. So when they do a bond issue, when a company does a bond issue, what they're doing, they contact an underwriter like Morgan Stanley or another company, another financial services firm, and they say, we want to do a bond issue. So they say, okay, so they're going to go through and draw paperwork. Bond issues take a long time to go to market. You don't decide this week you're going to market with a bond issue next week. This is a very long process. You might decide a year in advance. So when you're deciding you're going to do a bond issue, you decide on an interest rate. So you decide, I'm going to pay 5% interest on my bond. Well, when you go to market with that bond, the chances of the market interest rate being exactly what you're paying are very, very minimal. So what happens is the market will pay you less or more for your bond depending on the market rate of interest and your rate of interest on the bond. So we'll talk about this. Okay, bonds are always sold at the market price. A bond's market price is its present value. So basically with a bond, we're saying what's it worth today with today's interest rates. So a bond has two cash flows associated with it. The bond has the amount you're going to get at maturity, the principal. So that's one amount of cash with a bond. The other cash flow associated with the bond is the interest it pays. And that's an annuity because it'll pay the same amount of money twice a year for the length of the bond. So that is a cash flow. So what we do is we figure out the bond's present value with the market rate of interest, and they come up with the present value. This is all done for us on the market. The market's very efficient on pricing, and those bond analysts, they're actually doing this. They're figuring out the present value of the bond with today's interest rate given what the bond pays. So bonds are always sold at market price. There are two interest rates that set the bond price. First of all, the stated interest rate. The stated interest rate is also known as the coupon rate, It's printed on the bond certificate, and it's the one that we're paying cash interest to bondholders on. Okay, so we have the stated interest rate. And I'm going to go silent for a minute, let everybody finish writing, and then I'll talk some more. I see your name up there a lot. Get distracted by writing. It's easy to do, yeah. Lag. Magic. Okay, I think I see most people done writing. Okay, so things that I would consider extremely important and what I just put up, these two interest rates. This is where people get confused the most. There are two interest rates associated with the bond. The first interest rate is that stated interest rate. That's what the bond pays. That does not change. This will be a 5% bond. That's part of the bond contract, if you will. And so it pays the stated interest rate, also known as the coupon rate, because bonds interest is referred to as coupon dates, interest dates. So coupon is a word that refers to interest when we're talking about bonds. So we have the stated interest rate. So that's what the bond pays. Then we have the market interest rate, or the effective interest rate. This is what a bondholder could get on the market. Okay? This will vary minute to minute. The stated rate stays the same forever. Okay? The market interest rate can vary. So depending on when you're talking about the present value of a bond, the market rate will be different. So that's why price quotes, if you look in the Wall Street Journal and see bond price quotes, the prices will be different based on what day it is and actually what time of day it is. Okay, stated rate usually differs from market rate, and I put usually because it is possible for them to be the same. Not usually, doesn't usually happen, but so usually your stated rate is different from the market rate. Okay, this is important stuff. Again, I'm going to pause for a minute, let you write it down, because then we're going to talk through this. This is one of the most important things. This and the slide that we just talked about, very important in terms of being able to answer conceptual questions on this stuff. How are you today? Good. Great. Big day with energy. Okay. Okay. So we have this market rate and stated rate, and they aren't the same. So if I think about it, if I'm an investor and a company, let's put some numbers on here. So let's say, for example, our stated interest rate is 5% and the market rate is 5%. Well, I'm an investor. That means I can go anywhere else and buy similar bonds paying 5%, or I can buy this company's bond for 5%. It doesn't matter to me. When we say we're comparing market rate, this is market rate for the same risk level. So a comparable bond in terms of maturity, risk level, so everything else is the same. The market rate, the stated rate are exactly equal. We say that that bond is issued at par. That's the terminology. Par means at 100% of its face value, it's going to sell for exactly its face value. So if this is a $10,000 bond selling at par value, it will sell for $10,000, period. Okay, so now moving down to case B. The stated interest rate is less than the market rate. Okay, so let's put numbers on here. Let's say our stated interest rate is 5%. This bond is paying 5%. So every half year, it'll pay 5% times 1/2, because you get half the interest rate, half in half a year. So it pays 5% a year. The market rate, let's say the market rate is 8%. So investors are out looking to put their money somewhere. So they come across this bond and it's paying 5%. The market's paying 8%. What is any rational investor going to do? Go elsewhere, right? No one is going to buy our bond if we're paying 5% and the market's paying 8%. But we can't go back in time and change our coupon rate. We can't change that because that's fixed when we did the legal work. We can only pay 5%. So what we do to make our bond attractive to investors is we say, wait a minute, you don't have to pay us the full amount. So we're going to sell you a $10,000 bond, but we're going to sell you the bond at a discount. So maybe we'll sell it to you at 90%. So you pay us $9,000. We'll pay you the 5% on the $10,000, the whole life of the bond, and at the end of the bond life, we'll pay you back $10,000. So we always have to pay the bond face value back. So the investor gets that discount. It's called a discount. It's issued at a discount. And so this $10,000 bond that they're going to get $10,000 for at the end of the life, they only have to pay $9,000 for. That discount, we're giving them extra interest is what's happening. We're giving them a discount, this extra interest, to make our bond just as attractive as the market interest rate. So that's said to be issued at a discount. You will see all kinds of questions in study plan, perhaps in the homework, I know on the exam, where it'll say the stated interest rate of a bond is 5%, market rate's 8%. What's that? Is that bond going to be sold at par, at a discount, or at a premium? Well, this is where you refer to. You can reason your way through it, or you can just write it down and have it as a reference. Okay, so now the C, case C, the stated interest rate is greater than the market rate. So case C is market rate's 8%, but our bond's paying 10%. So we can go to the market and we can say, oh, we're paying 10%. The investors want our bond, so they're willing to pay extra for our bond because it's desirable because we're paying a higher rate than market rate. We're paying 10, market rate is 8, and these are just numbers I'm making up, so case C. Market rate is 8, stated rate is 10. We charge more, so our bond can be sold for perhaps 102, which is 102% of its face value. I just made up those numbers, but that's what's happening. So what's happening behind the scenes to get those bond prices? The bond prices are the present value of the bond, and the present value of the bond is both the face value and that annuity, that stream of interest payment. So what's the present value? And when we calculate the present value, we're calculating the present value that makes the interest, the effective interest on the bond, equal to the market interest rate. Okay? So this slide, real important in terms of being able to answer some questions. Okay, so I guess I was just making a note. So we have 6 homework problems. A lot of them are very, very short. Okay, so the first one, short exercise 9-1. So we're going to do a note payable. So we're going to switch gears here. We're going to do a series of homework problems. They purchased inventory costing $11,000 by signing a 12% short-term note payable. The purchase occurred on July 31st, and they pay annual interest each year on July 31st. So they made the dates easy for us. Journalize the company's purchase of inventory, accrual of interest, and payment of the note plus interest. Okay? And so First thing we're going to do is we're going to do the company's purchase of inventory. Okay, so the very first thing that's happening here is first sentence. It says Gordon Sports Authority purchased inventory costing $11,000 by signing a short-term note payable. What are we going to debit? What are we getting? Inventory. And inventory is what kind of account? Asset. And to increase it, we debit it. So we know we're going to debit inventory. You want to take a shot at the credit? The other side, so we purchased inventory, which is our debit side, by signing a short-term note payable. It has to be note payable, right? And it has to be a credit because it's the other side of this. So what we're going to do here is we are going to debit inventory and credit note payable, short-term note payable. And we have that little memo line. Again, these entries that I'm going through with you now are very, very standard entries. So when we purchase inventory with a note payable, this is what the entry is going to look like. We purchased inventory for the cost, the $11,000. We're going to increase liabilities for the $11,000. So that's what's going on with that first entry. Okay, entry B, accrual of interest expense on April 30th. Okay, so some notes here. We're accruing interest expense on April 30th. It tells us that's their year end. So we did this transaction July 31st, 2012. And again, I would not hesitate to count months on my fingers if that's what it took, because that's the biggest point of people stumbling here, is not getting the right number of months. So in this example, if we got it July 31st, the date we get it doesn't count for interest. So we can do whole months here. So we're going to have August, September, October, November, December. There's 5 months plus January, February, March, April. That's 9 months. So again, this is the single biggest stumbling block, is getting those months. So there's 9 months. So we want to accrue interest expense for 9 months. Well, interest expense on the bond is going to be $11,000 times 12%. That's for a whole year, and then we're going to multiply by 9/12. So what we're going to do, I'll write it, it's up there, copy it down, and then I'll talk. Okay, so what's going on here is we're accruing interest expense. So this company bought inventory, and to pay for it, they said, we'll pay 12% on a note payable to the company that's financing it. So 11% times 12%, 11,000 times 12% would be the interest for a whole year. But we're only talking about from August 1st, 2012 through April 30th, 2013, because that's when our financial statement year ends, is April 30th. So we do the $990 as our interest expense, and then we'll credit interest payable because we've held the bond for 9 months, so we do have a liability for that interest. Okay, so we're going to debit interest expense, credit interest payable. Okay, and then finally, payment of the note plus interest on July 31st. Okay, so we pay the note plus interest. So on July 31st, we know we're going to pay a full year of interest, right? We're going to take the $11,000 times 12%. So we'll have a full year of interest. We also know that we're going to pay cash, and our cash is going to be the $11,000 plus the interest. So I'm going to put the journal entry up here, and then we'll talk through it after we write it down. Okay, so what we've got here, and this again, these are very good journal entries to know, because you might see these are standard journal entries. First thing we're doing, so let's walk through the journal entry, what's going on here. First thing, that first line, that note payable debit there, we are removing the liability. We're paying it off. We had a liability for $11,000. We're removing it. We initially set it up in entry A. We credited note payable for $11,000. Now we're debiting note payable to eliminate it, so it's gone. Okay, then the next entry down, interest payable. That accrual that we made in entry B, where we credited interest payable, we don't have that liability anymore because we've paid it all off, so we need to wipe out the $990. Then the next entry down, interest expense, is the amount of interest expense we have from the last time we accrued to now. If I were doing this entry, I would do note payable for $11,000, interest payable for $990. I would skip that line. I would leave a blank line, and then I would go to my cash. My cash is going to be the $11,000 plus the total interest, which is the $12,000. The 12% times 11,000. So I can get the cash amount, and then I would plug for the interest expense. But know that you can do it line by line just like this. The journal entry will always be that first one, note payable, is for the face amount, the amount you borrowed. The interest payable is for the amount of the accrual that you just did. The interest expense is for the amount of the interest from the last time you accrued to now. And then cash is for the principal amount plus the full interest. So that is how you do a repayment of a note. When you're paying off a note, that is what you're doing. Okay, now the next item on this exercise, show what the company would report on its balance sheet and on its income statement. So we're not doing a full balance sheet, we're not doing a full income statement, but we're just showing what they would show. Okay? So what would they show on their balance sheet? What would they show on the income statement? Okay. So balance sheet on April 30th. We prepare financial statements at the end of the year. The year end was April 30th. So note payable we had for $11,000. That would be a liability. Interest payable for $990. And then income statement would have interest expense. Okay, balance sheet, note payable short-term, interest payable, those are both current liabilities. How do we know? It says short-term, interest payable, we're going to pay the interest within a year. So those are both current liabilities. Income statement, interest expense, and note that both of these are April 30th. The question asks what they would report on their balance sheet at April 30th. So question C, item C, when we did the journal entry for C, it referred to what we were doing July 31st. So D asks us to go back to the balance sheet date, April 30th. So just to note that that's why those numbers are different from C. Okay, so that is short exercise 9-1. So that's not bad. Again, this week's Chapter 8 homework is so light, I would go ahead and start on some of these and get them out of the way. Okay. Ooh, couple questions. Start with a true-false question. A current liability must be paid out of current profits. True or false? Okay, what do you think? False? Okay. What do you think? Not sure yet? Okay. False? True? True? You think it's true? Okay. Over here? True? False? True? True? Let me head over here and getting a variety of answers. What do you think? False. 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 Oh, a pocket of false. What do you think? False. False. And You know what I was going to say. False? Oh, whatever. False? Oh, this side of the room is heavily false. False? Like? False? Okay. And I started with you. So I think I've hit everyone. What do you have, Haley? What are you seeing? 1 true and 14 false? Okay, good, good. Glad to hear that. It is false. Current liabilities have to be paid out of cash. Okay? And this is a good question. I mean, because it kind of reinforces that need to think about what we're asking and read carefully. Now, another reason, if we think about, I mean, obviously current profits are always good, but they're not necessary for paying bills. We have a tremendous number of startup companies that don't have any current profits that do pay their bills. Amazon has losses many, many years, but they pay their bills. So the investors are providing cash to be paid. So we need to pay current liabilities out of cash, not out of profits. Profits and cash payments are kind of disconnected. Sometimes there's very legitimate reasons a company doesn't have current profits, but still is able to pay its liabilities. Okay. Purchasing merchandise inventory on account results in a liability. True or false? What do you think? True? Okay. What do you have, Haley? 18 trues and 1 false? Okay. So that is true. Okay. We purchase merchandise inventory on account. That is a liability. We get the inventory. We have a liability for it. Okay. Compute the price of the following bonds. I'm going to give you a minute or two to try it, and then we'll go over these. So give them a try. Get out your calculators or phones. Yeah. Okay. On this one, the first one, 200,000 issued at 77.75. That's 155,500. So we're just taking 0.7775 times the 200,000. The second one, 200,000 issued at 103.5 is going to be 207,000. See? I mean, when I'm looking at, yes. They're all, is that a percentage? When we talk about bond quotes, bond prices, they are always talked about like 77.75, and that translates into how you do that is you make it a percentage. Yeah. Yeah. So all of these you're taking the percentage. Was that your question too? I'm sorry, you had your question. No, where do you get the first number? That's the 200,000. That's the answer. So that's the 200,000 times 77. Okay. Okay, and then that last one. So I'll pause for a minute while you're writing those down. Okay, let's see. Pretty close. Close enough. You got them down? Just about. Almost. Good? Okay. 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 So those aren't bad. Bond prices are not bad. Just convert it into a percentage and you're good. When you open up the Wall Street Journal, they are quoted as 77.75 or 77.125. They're usually an eighth percentage-wise. Okay, so that's 9.6. So that one's a really easy one, an easy one to knock off this week. Okay, bond with a face value of $1,000 and a quoted price of 102 has a selling price of 1,020. True or false? True or false? True? Okay. Yes, that is absolutely true. So those should be pretty easy for you figuring out the price of a bond given its quoted price. Okay, now remember a little bit ago we had that page, the slide that I said was really important where it compared stated rate to the market rate and whether it's sold at par, at a discount, or at a premium. This whole exercise is about whether each one of these is issued at par, at premium, or at a discount. So the first situation, so exercise 9-7, situation A, the market interest rate is 7%. The company issues bonds payable with a stated rate of 6.5. So is that, so let's just talk about this. I'm picking on you first. Yay. Okay, so let's go with 7A. Market rate 7%. We issue a bond with 6.5%. Okay? So market's paying 7. We're paying 6.5. So let's ignore notes for the moment. Okay, let me just put you on the spot here. Okay, so the market's, and you can figure these out. The market's paying 7%. So you're an investor going out to invest your money. Everybody on the market's paying 7%. Horton Company comes to market with paying 6.5%. Right. So the investor to buy Horton, do they want a discount or are they going to pay a premium? The market interest is higher. Now, okay, now keep in mind, we're pricing this from the standpoint of the investor. So I'm an investor. Say you've got $1,000 and you're going to buy a bond, okay? Do you want to buy the bond paying 7% or 6.5%? No, wait. You're buying a bond that pays you money.
Oh, okay. So I'm looking at that. Okay, so yeah, I get more.
Right. So the investors are the ones that dictate. Right. The company wants to pay as little interest as possible. But yeah, but that's good. I mean, so the company wants to pay as little interest as possible, but these are priced from the standpoint of the people buying the bonds. So market 7%, Horton is paying 6.5. So is the market going to be even on that, or are they going to pay a discount, pay less or pay more? Okay, for you to buy this, are you going to pay more for it or are you going to pay less for it? You're an investor. You can go earn 7% on the market. This one's only paying 6.5. Okay. Well, you want the 7, right? What am I going to have to do to get you to buy my bond? They can give it to you cheaper, right? So a discount. I'm going to discount it. You see where I'm going with this? Yeah.
Not really. Okay. So which standpoint are we looking at it from? Because, for example, only reason why I said, okay, market is bigger. Okay, so I just mixed them up. Okay.
Yeah. I was just trying to reason our way through. So if we think about what's happening here, keeping in mind that investors are the ones that dictate the market price because they're the ones deciding where to put their money, right? So the investor says, I can earn 7% elsewhere. Horton is only going to be able to issue its bond if they give a discount. So my bonds, Horton's bonds, $1,000. They'll say, I'll give it to you for $950. You know, so you get a discount on it, and that in effect gives you extra interest on it to make up.
Okay.
Okay, so you're saying par, premium, or discount? Discount. Perfect. Discount. Good. Okay. Good. You want to try another one?
Sure.
Okay. Okay. So let's go to B. So Sharp issued 6% bonds. Okay. So the stated rate is 6%. Market rate's 5 3/4. Right. Yeah, exactly. So the stated rate is higher or bigger than the market rate, so that's a premium. Because as an investor, market's paying 5 3/4, but now Sharp is paying 6, so I'm going to be attracted to that. I'm going to be willing to pay a little extra for that. Okay, got it? Okay. Want to do the next one? I'm just going to stand here. What the heck? We've done this far. Okay. C. Houston Corporation issued 3% bonds when the market interest rate was 3%.
Par.
Par. Yes. Okay. So that's even. That one's easy. Right. Okay. And then our last opportunity, Ontario company issued bonds payable that pay a stated interest rate of 8%. At issuance, market interest rate was 8 1/4. Yes, yes, absolutely. It is a discount. Okay, so D is a discount. Very good. See? Yeah, yeah. Okay. It'll make sense later. So this is a good one to try later today too. But the market on this last one, D, we issued bonds payable that pay stated interest rate, so they're paying 8%. Market's paying 8 1/4. The only way any investor is going to buy Ontario company's bonds is if Ontario company gives a discount on their bonds. So, okay, so that's 9-7. Okay, so more of this bond market rate, interest rate. If the interest rate on a bond is 8% and the market interest rate is 7%, the bonds will be issued at a price above the par value of the bond. True or false? I'm here for you. Yeah. Okay. Now, before we answer this, if an interest rate on a bond is 8%, that doesn't say stated interest rate or coupon rate, but that is the interest rate. Our interest rate on a bond refers to the stated rate. So you can have subtle differences in the way it's phrased, but the interest rate on bond, that's saying this bond pays 8%. Okay, so the bond's paying 8%. Market rate is 7. Okay, so the investor can go in the market and get 7%, or they can buy this bond paying 8%. Our investor is going to be willing to pay more or less for this one. They're going to pay more, so the price will be premium, above. This is true. I mean, you knew it true. But if investors pay more for the bond, it's a premium. It didn't ask that, but I'm just adding that on.
Oh, I thought if we pay more.
Well, what we're doing, okay, so the price is above, if the price, so in this case, let's back up for a minute. The market interest rate is 7%. So the market's paying 7%. Our bond pays 8%. So investors are like, wow, that's a really desirable bond. We'll pay more than the face value. So that's a premium. Okay? If the market rate was higher than our bond, then we would have to give them a discount. We give them a discount if we're not paying what the market is.
Oh, I thought like we were buying.
Well, okay. We always look at it from the we can. We always look at it, the people that dictate the price of the bond are the buyers. So that's why it's easier to look at that. So we are buying the bond, okay? We're buying the bond, the market rate 7%, this bond is 8%, we're willing to pay more than the face value because it's paying more. And when we pay more, that's a price above the par value or premium. Okay? Okay, at this point, this is your lucky day. We are going to do the easiest pop quiz you've had the whole semester. Okay? So what we're going to do is, first of all, I want to review what's due. Don't go anywhere if you're online. Don't go anywhere if you're in person. We're going to do a pop quiz, but I want to put up what's due here. Okay, so reminder about what's due. Okay, so what's due this week, we have the attendance quiz, we have the Chapter 8 homework, and Sunday we have the video quiz over Chapter 9. So those are due. Remember that next week we do not have class exactly. Monday the university is closed in observation of Veterans Day. Wednesday we do not have live class. That will be recorded. Now if you're watching this video later, you can quit watching now. It's going to run for a few minutes. It's just going to be live chatter. So you're done watching it, but we have to let the recording run. So what we're going to do is online, if you're online, type, you've been online, but we need you to type your full name into the chat window to Haley, and that's it. If you're in person, I'm passing around a 2 pieces of paper, one for each side of the room, okay? And your name has to go on each one, and I'm going to make sure you only sign your name, because the only thing having to do with this, I'm going to count how many people are in here. Okay? And if there's more names than what's in here, no one gets credit. So you either get 100% or 0. Okay? So one name, your name on the sheet. So one, right? And you're getting people, so I can't see on the, okay. Okay, so if you're online, sign your name in the chat window. If you're in person, did you get it, Phil? Phil missed it, so, okay. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25. There should be 25 names combined between the 2 sheets. Just your printed name's good. Just write it neatly so I can read it. Yes? Yeah. Don't come in right at 2, but yeah, because I have a class at 2:15. So I have office hours at 1 today, and I also have office hours 9:30 to 11 today as well. Okay, so one name per person. If you're online, that's all you need to do. Has everyone signed in online? If you've typed your name online, then you are free to exit. And we are going to be, you have about another minute to sign in online, and then we're going to be stopping the recording in 1 minute, Haley? In 1 minute. Give it 1 minute. Just confirm online that everybody's signed in. Your pop quiz scores from Monday are in My Accounting Lab now. You may want to check those out. Otherwise, if you've signed the sheet with one name, then you are free to go. And the last person to get that sheet of paper gives me the sheet of paper at the door. How's that? Okay? Have a nice weekend. I'll see you in 2 weeks, but I'll be emailing you in the meantime.